So I want you to picture something for a second. It's a Tuesday night. You just got paid. You open your banking app, check your balance, feel okay for about 3 minutes, and then rent hits. Then your car payment, then groceries, then that subscription you forgot you had. And suddenly you're sitting there thinking, where did it all go? That was me. For years, I kept telling myself I'd start investing once I had more money, once I paid off my card, once things settled down. And every month, the goalpost moved. Here's the thing. That's not a money problem. That's a knowledge problem. Because once I actually understood how this stuff worked, it changed everything. Not overnight, but steadily, quietly. My money started doing things for me instead of just disappearing. And today, I want to walk you through exactly what I would do if I were starting from zero in 2026. No inheritance, no finance degree, no big salary. Just a phone, some consistency, and a plan. Welcome to Smart Invests, and I spend way too much time thinking about how ordinary people can build real wealth without needing to be rich first. If you're someone who's tired of watching your paycheck vanish before the month is over, and you're ready to actually do something about it, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. All right, let's get into it. Here's what most people don't realize. The average American earns somewhere between $1.5 and $2 million over their entire working life. That's a life-changing amount of money flowing through your hands. And yet, according to Federal Reserve data, the median retirement savings for households approaching retirement age is just around $87,000. That's 3 to 4 years of expenses. For some people, it's less. So what happened to the other $1.9 million? A lot of it got eaten by lifestyle inflation, by debt, by keeping money in a checking account where it does absolutely nothing. And here's where I want to challenge something you've probably been told your whole life. Just save your money. Look, saving is important, don't get me wrong, but saving alone isn't enough. In fact, if you're only saving and not investing, you are slowly losing wealth every single year. Let me show you why. As of early 2026, U.S. inflation sits around 2.4% annually. That sounds harmless, but here's the math. If you have $50,000 sitting in a regular checking account earning close to zero interest, in 10 years, that money will only buy what $40,000 buys today. In 30 years, it has the purchasing power of roughly $27,000. You didn't spend it, nobody stole it, but you lost almost half your wealth just by letting it sit still. Now, you might be thinking, okay, but I use a high-yield savings account. Fair, that helps. But here's the truth. Most high-yield savings accounts barely keep pace with inflation. You're treading water at best. And treading water doesn't build wealth. This is where investing changes everything. This is where it gets really interesting. The U.S. stock market, specifically the S&P 500, which tracks the 500 largest American companies, has averaged around 10% per year going back nearly a century. After adjusting for inflation, that's about 7% in real returns. Now, let me put two scenarios side by side for you. Scenario 1. My friend Marcus puts $400 a month into a savings account earning 4%. After 30 years, he has around $277,000. Not bad. He contributed $144,000 and nearly doubled it. Scenario 2, my friend Priya puts the same $400 a month into a low-cost index fund, earning the historical 10% average. After 30 years, she has just under $905,000. Same monthly amount, same 30 years, nearly 4 times the result. That gap, over $600,000, comes entirely from one thing: compound growth. Einstein supposedly called it the eighth wonder of the world. I don't know if he actually said that, but whoever did, they were right. At 10%, your money doubles roughly every 7 years. At 4%, it takes closer to 18. That difference, over a lifetime, is the gap between working into your 70s and retiring comfortably in your 60s. Accounts, where your money actually goes. All right, let's talk about where to actually put this money, because this part matters almost as much as what you're buying. You need something called a brokerage account. Think of it like a bank account, but instead of just holding cash, it holds investments. Now, there are two flavors: retirement accounts and regular taxable accounts. And the difference comes down to taxes. A 401k is offered through your employer. For 2026, you can contribute up to $24,500 per year. If your employer matches contributions, say 50 cents for every dollar you put in, up to 6% of your salary, that's an instant 50% return. Free money. You should always grab that first. A Roth IRA is one you open yourself at any brokerage. You contribute after-tax dollars, meaning no deduction today, but everything grows completely tax-free. When you pull money out in retirement, zero taxes, nothing, on decades of compound growth. For 2026, the limit is $7,500 per year, and income limits apply if you earn above $153,000 as a single filer. There's also the HSA, Health Savings Account, if you have a high-deductible health plan. This thing has a triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. It's arguably the most powerful savings vehicle most people have never heard of. For platforms, Fidelity and Schwab are both excellent, with zero commissions, zero minimums, and great customer service. Vanguard pioneered low-cost investing and is rock solid. Robinhood has a clean mobile interface and now offers IRAs with a contribution match. Pick one. Open the account. Don't overthink it. What to actually buy. Okay, so now you've got the account. What do you actually put in it? Here's where most beginners make a costly mistake. They try to pick individual stocks. They hear about some company that's blowing up and they buy in. Sometimes it works. A lot of the times it doesn't. Here's what most people don't realize. The majority of actively managed funds, run by professional investors with entire teams of analysts, fancy algorithms, and decades of experience, still underperform simple index funds over 10-year periods. Multiple studies confirm this. If the pros can't consistently beat the market, what chance does someone researching stocks on their lunch break have? Enter the index fund. An index fund doesn't try to beat the market. It just owns all the stocks in a given index, like the S&P 500, in proportion to their size. When you buy one share of an S&P 500 index fund, you instantly own tiny pieces of 500 companies: Apple, Microsoft, Amazon, Google, JP Morgan, Johnson & Johnson, and hundreds more. One purchase, 500 companies. If one fails, your portfolio barely notices. And because index funds don't pay armies of analysts, their fees are incredibly low. The expense ratio, the annual fee, on top S&P 500 ETFs is around 0.03%. That's 3 cents on every $100. Compare that to a 1% actively managed fund. My friend Jalen invests $400 a month for 30 years at 10% returns. With a 1% fee, he ends up with roughly $720,000. With a 0.03% fee, he ends up with about $905,000. Same investment, same returns, nearly $185,000 just from fees. The funds I'd actually use: VOO or IVV for S&P 500 exposure at 0.03%. VTI if you want the entire U.S. market, all 3,600 plus publicly traded companies, also at 0.03%. VXUS adds international exposure if you want it. And if you want a simple one-fund solution, target date funds do all the rebalancing for you automatically. You don't need complexity, you need consistency. When and how much to invest? Now here's where people get stuck. Timing. The market's at an all-time high. Should I wait? There's an election coming. Should I wait? The economy feels uncertain. Should I wait? Look, I get it. The impulse to wait feels responsible, but here's the data. The S&P 500 spends about 8% of all trading days at all-time highs, and research has consistently shown that investing at all-time highs produces essentially the same long-term returns as investing at any other time. Markets that hit new highs tend to keep hitting new highs. Waiting for the perfect moment usually means missing the gains that happened while you were waiting. The strategy that works, both mathematically and psychologically, is called dollar cost averaging. Instead of trying to time a big lump sum, you invest a fixed amount on a regular schedule, $300 a month, every month, regardless of whether markets are up, down, or sideways. When prices are high, your $300 buys fewer shares. When prices drop, your $300 buys more shares. Over time, you average into the market at a reasonable cost, and you remove emotion from the equation entirely. But here's the real secret. Automate it. Set up a recurring transfer from your checking account to your brokerage. Set up automatic purchases of your chosen fund, and then step away. Check quarterly, not daily. The investors who build the most wealth are often the ones who make investing so automatic they almost forget it's happening. As for how much, aim for 15 to 20% of your income if you're starting in your 20s. But honestly, start wherever you can. $100 a month consistently for 30 years at 10% becomes around $226,000. $300 a month becomes $678,000. $500 a month becomes just over $1.1 million. Increase the amount every time you get a raise or pay off a debt. Let the number grow with your life. The psychology. Why smart people still lose. Here's the part that nobody talks about enough. The math is actually the easy part. The hard part is your brain. The historical average of 10% per year is not what you'll feel in any given year. Some years you'll be up 25%. Other years you'll open your app and watch your portfolio drop $8,000 in a week, and your brain will tell you to do something. Sell, get out, wait until it's safe. That instinct will cost you more than any bad stock pick ever could. In 2022, the S&P 500 dropped about 19%. A $100,000 portfolio became $81,000. Thousands of people sold at the bottom, locked in their losses, and sat in cash while the market recovered. In 2008, the market dropped over 50%. The people who held and kept buying, the ones who stayed the course, they came out on the other side wealthier than before the crash. So how do you protect yourself from your own emotions? 1. Keep a 3 to 6 month emergency fund in a high-yield savings account. This means you'll never be forced to sell investments at the worst time just to cover rent. 2. Only invest money you won't need for at least 5 years, preferably 10 or more. 3. Write down your plan before a crash happens, not during. Decide in advance, if the market drops 20%, I will continue my automatic investments. If it drops 40%, I will continue, and maybe invest more. Having that written down when you're calm makes it easier to follow through when things get scary. 4. Stop checking your portfolio every day. Every time you look, you're tempted to react. Quarterly check-ins are plenty. Okay, let's bring it all together. If I were starting from zero today, here's the exact order I'd follow. Step 1. If your employer offers a 401k with a company match, contribute at least enough to capture the full match. That's an immediate return on your money that no investment can beat. Step 2. Build a 3 to 6 month emergency fund in a high-yield savings account. This is your buffer. Without it, you're one car repair away from cashing out your investments. Step 3. Open a Roth IRA and contribute up to the $7,500 annual limit if you're eligible. Tax-free growth for decades is one of the best gifts you can give your future self. Step 4. If you have a high-deductible health plan, open an HSA and max it out. Triple tax advantage. Don't sleep on it. Step 5. Go back to your 401k and push contributions toward the $24,500 maximum if you can. Step 6, if you've still got money to invest after all that, open a regular taxable brokerage account and keep going. In every single account, keep it simple. A low-cost S&P 500 or total market index fund. Automate the contributions. Reinvest dividends. Leave it alone. A few mistakes I see constantly and that I made myself early on. Waiting to start. There's no perfect time. Every year you wait costs you exponentially more than you realize. Start small. Start now. Picking individual stocks before you understand the basics. Index funds are boring. They don't make great party stories, but they build wealth reliably without requiring luck or expertise. Checking your portfolio too often. Daily monitoring leads to emotional decisions. Set it and step back. Selling during downturns. Every major crash in market history was followed by a recovery. Selling locks in losses and removes you from the rebound. Paying unnecessary fees. A 1% expense ratio versus 0.03% seems small. Over 30 years, it could cost you hundreds of thousands of dollars. Use low-cost index funds. Treating investing is optional, something you do with whatever's left. Pay yourself first. Automate the investment before you have a chance to spend it. Here's the truth. None of this is complicated. It just requires you to actually do it. Open the account. Set up the automatic transfer. Buy the index fund. Walk away and let time work in your favor. That one action, done consistently for years, will put you ahead of the vast majority of people who know all of this but never start. The gap between knowing and doing is where wealth dies. Don't let that be you. If this video helped you, hit that like button. It genuinely helps more people find this channel. Subscribe if you want more content like this. And drop a comment below. Are you just starting your investing journey, or are you already a few steps in? I read every comment. I'll see you in the next one.